Hey soldiers, the IRS may be coming for your savings account.
What you gonna do when they come for you?
The IRS may be coming for your savings account, but don't worry, it's not as bad as it sounds. Now that is a headline from MarketWatch, okay? They are the purveyor of financial information, one of many. But they are big corporate media also. So we're going to get into this and we're going to examine this. Banking, consumer banking is quickly becoming, I'm not going to say obsolete, but it's evolving away from the traditional model. And the advantage is actually in the hands of the consumer, not the banks. So what is this article? What is it all about? Who are MarketWatch's sponsors? And is the IRS coming for your savings account? Actually, that's nothing new. The IRS has always had purview over your savings account in terms of being able to collect taxes from the interest you earn. This is nothing new. Why is it coming up now? Well, look, let's take a look at it and examine it so that you know what to do moving forward. High yield savings accounts are paying far more than they used to, which will overall earn you more, even if you owe the IRS some of your earnings. Now, they go on to say, for years, savings accounts have paid an abysmal rate of interest. But in recent months, now check this out, but in recent months, we've seen accounts paying far more. Currently, the range for high yield online savings accounts is between 1.6 and 2.15% compared to far less than 1% last year. Now, let's slow down here for a second. First of all, inflation, let's just take the headline number, okay? Let's not even get real fancy with it. We know, because we're soldiers of finance, we know that inflation is over 16%, real, true inflation. We've been through how they manipulate the numbers. We've been through that time and time again. But let's go ahead and let's just play their game. Let's take 8.3%, which is the year-over-year number for August, okay? 8.3%. If you're out there paying, on average, 8.3% higher for everything you purchase, then what in the world is 2.15%? That's still abysmal because it's not helping you to keep up with inflation. The value of your money is far less at 2.15% if inflation is over 8%, the headline number. If you take food inflation alone, now food inflation for August was over 11%, okay? So if you take food inflation alone, then you are 8.9% behind the eight ball if you're looking at this savings account as something that's going to help you actually make money, okay? Then on top of that, the IRS, they get their pound of flesh from your earnings.
I want my money.
That said, there's one thing to remember here. Interest from your high yield savings account is generally taxable. You won't be taxed on your contributions, okay, because you've already paid money on that. So you are, in fact, taxed on your contributions. You've got to read this stuff carefully. Corporate media is a beast. And if you can't parse this stuff out, they will have you making moves that are deleterious to your situation and actually putting you in a worse position, quite probably, than what you started out in. All right, so Alana Benson, she's an investing spokesperson for Nerd Wallet. She's the one that said, hey, don't forget, you won't be taxed on your contributions. Yeah, you will. Because if you earn money from your job or from your business, and then you take some of that money and you put it into the savings account, you have to pay taxes on the money you earned that you're putting in the savings account, right? So you already paid taxes on it. It's not that you won't be taxed on it. You've already paid taxes on it. MarketWatch knows this. I don't know why they're trying to make it seem like there's something else going on here. You'll never pay more in taxes than the interest you earn, okay? So what they're saying there is you're going to pay taxes on the interest. Yes, that's absolutely correct. So you're going to be in a situation where you're paying interest, where you're paying taxes rather on the interest, and still being in a situation where inflation has impacted you. So it's even less than 2.16%. Okay. That top rate that they cited earlier, once you calculate the taxes that you have to pay on the return, then it's even less than 2.16%. To me, this seems like an advertisement for banks. Back during the pandemic, the Fed had reduced the reserve requirement for banks to 0%, which meant that they didn't have to have a certain percentage of the amount that they loaned out in reserves sitting in cash in the bank. They took it down to 0. Now, at that point, banks they didn't really need your money. The Fed, the banks, the politicians, they wanted money out on the street trying to, keep the economy afloat, even though these idiots shut down the economy. Okay, this is the brain trust we're dealing with. So now we're in a situation where a lot of people have found ways to put their money into different things and have it perform better than a savings account. We always talk about a permanent life insurance policy, for example. That thing is going to give you all kinds of tax advantages that you're not going to get from a bank savings product, and you're still going to have the ability to put money away, have it grow, and have a death benefit at the end of the day. So people have done that. People have put their money into the markets. Okay, people have put their money in real estate. People have, diversified, especially since a lot of people were just saying, you know what, I'm going to keep my powder dry. And then there became these opportunities to start getting that money working. And the banks just weren't the place to go because interest rates were so low and inflation started to rise. So here we are at a point where the banks have probably approached MarketWatch and say, hey, draw up a story for us and get some of these depositors back in here.
60% of the time, it works every time.
Because the reserve requirement is no longer 0. Okay, they do have to have a certain amount of, the last thing I looked at said like somewhere in the neighborhood of 7%. But that could have changed by now. A couple earning $150,000 with a top marginal rate of 22% taxation, who splits $50,000 between a money market and a savings account, might expect to earn $550 to $600 interest on their savings. At 22%, this will increase their tax bill by roughly $121 to $132. Okay, so if you earn more than $10 in interest on a bank savings product, you are liable for taxes on that. Let's say you're at the 22%, somewhere in that 22% range for taxation, then that means you're going to owe the government $2.20 of that interest you earned, that $10. And so now you are in a position where you have not earned as much interest on that as you thought you did. Now, here's something that I want you to take away from this. It's going to help you out tremendously. It's called the rule of 72. It's an easy calculation that's going to instruct you on how to figure out how hard your money is working for you. Now, all you got to do, it's reputed that Albert Einstein thought of this, okay? I'm not certain, but this sounds like something he would have come up with. In any event, the rule of 72 is quite simple. You just take the number 72 and you divide that by your return. So let's say we'll go ahead and divide 72 by 2.1. That is the amount that they gave us that we should be able to, start jumping up and down and get excited about. It's called a high yield savings account. Can you believe that? 2.1% high yield in a double digit inflationary environment, but whatever. So it will take you 33 years to double your money if you invest it at 2.16%. Okay? So use that rule of 72 when you're looking at the return expectations on other vehicles as well to kind of see when is my money going to double. Now, what you got to do is you got to keep in mind that every asset is not meant to perform in the same way. Give you a perfect example. A lot of people say that gold is an investment. Gold is actually a hedge. It is an asset. It's a hedge against inflation. So gold is not to be expected to go out there and perform like Amazon stock has, okay, or Apple stock has. Although gold is extremely competitive when you put it up against the S&P 500 in terms of return. But gold's purpose is to preserve your purchasing power, okay? And it does that over the long term. Some people like to say, look, gold was down last month. See, the whole 5,000 year, supposition is invalid now. No, you just need to look at things over a long-term basis. If you have that trader mindset, and again, this is no shade to traders. Traders make money if they know what they're doing. This channel is dedicated to the long term, okay? So if you are out there and you're investing in something like gold, it has a different return expectation, a different purpose than something like a stock, okay, which is meant to provide you with appreciation on the value of the asset and maybe even income in the form of a dividend, okay? So these tools in your toolbox, your financial toolbox, all have specific purposes. And when it comes to the savings account, I'm prepared to say it is obsolete. Okay, what is it there for? Other than, sure, you want some money in an account so that you can pay your bills. Okay, so you pay your bills. You might need to shuffle some money from a savings account to a checking account, but you're not making any money there. The purpose of that is more so for financial convenience. So where should you put money then that you need for, say, an emergency account? Because that needs to be liquid, but it also needs to be working. And I swear to you, that's why you need to look closely at the insurance policy, because that is a place where your money can continue to grow. It can be safe, but it's liquid and it has tax advantages. Now, many people will, poo-poo the cost of insurance. Wherever you put your money, there's going to be some sort of cost associated with it. Either it's risk in the form of, a stock. Look at the stock market right now. It's pretty volatile. That's not a bad thing, but there is a cost of risk there. You can put it in a savings account, and we've already showed you how you're not even keeping up with inflation. You're so far away from inflation, and then the tax man is going to come and want his fair share. Okay, unfair share, many may say. So that has a tremendous cost associated with it as well. So you got to look around and see, if you're going to pay a cost, what are you going to get for it? And in the insurance policy, you are paying the cost of insurance, but you're getting 3 important tax benefits: the ability to get your money tax-free, get a hold of the money, okay, tax-free. You have the ability to watch that money grow and appreciate tax-free, unencumbered by taxation. And you have the ability to pass the money on to heirs, again, unencumbered by taxation. Not to mention the fact that there is that final benefit there. So think outside the box. Market Watch is shilling for the banks here, and it just doesn't add up. Okay, soldiers, I want you to take a look at this video. It's about how the IRS is going to go in and make drastic overhauls to how we as Americans pay taxes. Now, one of the things that they're proposing is ending the refund check. And that may not be such a bad thing. If you want to find out why, go ahead, watch the video. Guys, I will talk to you soon.